Well, the Brexit cliff edge comes ever closer, and the performance of sterling continues to be a real focus for investors as that March the 29th date comes into view, or perhaps more importantly, those succession of votes in the UK Parliament from March the 12th. Now, the question is, how should investors be positioned in terms of those votes and the probabilities that are likely to come out of them? Well, it does look increasingly likely that the government and the Prime Minister is going to struggle to really turn around that horrendous performance in the meaningful vote 1 back in the middle of January, when the Prime Minister suffered a defeat by 230 votes. Now, it may well be the case that on March the 12th, the scale or the margin of the Prime Minister's or the government's defeat will be smaller, but it looks increasingly probable that the government will not be able to push through its current deal because of opposition from both members of the right wing of the Conservative Party under the ERG, but also the DUP. So the question is, how does that relate to sterling's performance going forward if the government are not going to be successful to push forward with their withdrawal deal in mid-March? Well, of course, then it puts us through to those other successive votes on March the 13th and March the 14th on a no deal. Now, that clearly will be ruled out by Parliament. And then in terms of the postponement of Article 50. And here, I think, comes a rather more troubling phenomena for UK investors, because it has been the baseline presumption that if we were to see an extension of Article 50, so a delay in the exit process, that sterling would rally accordingly. But it really depends on what sort of scale of extension we would be looking at if the UK could engineer that with its European partners. Because, of course, asking for an extension of Article 50 is one thing. Actually, seeing it granted by the other 27 national governments is another. So I think in the short term, it may well be the case that markets will be speculating on that July the 1st date, immediately ahead of the formation of the new European Parliament, as a fresh extension date, but that will merely add to the risks of a much greater degree of cliff edge scenario for sterling on that basis, because of course if the UK does not take part in the EU parliamentary elections in late May, then it does create increasing problems in terms of democratic representation into the new European parliamentary process. So I think it may well be the case that those that are hoping that an extension of the Article 50 process into early July will encourage a rebound in sterling and sterling sentiment, I think may well prove to be a little bit misplaced. So ultimately, I think it's a classic scenario that we have seen markets increasing their confidence that a hard cliff edge Brexit will be avoided over the course of the last few weeks and months, certainly since early December. But I think after getting up to the sort of the 133.5 area in terms of sterling against the dollar, there was and proved to be a short and fleeting opportunity for an opportunity to sell that rally. And I think it may well be the case that in the shorter term, sterling bears will remain in the ascendancy, because the risks of a short-term extension just adding to the uncertainties both on the macro environment. So Q1 growth will be very weak. It will be perhaps 0 or perhaps only 0.1 quarter over quarter, but a mere extension of the Article 50 process through Q2 will merely extend that period of lackluster growth. And I think accordingly we will see sterling once again remaining under pressure. So those that are hoping that a Brexit resolution will be beneficial for sterling and see us trading back north of 140 against the dollar, I think we'll have to hope and expect there will be an eventual resolution of the Brexit process. But for now, at least, I think the bears, as far as sterling, will likely remain in the ascendancy.